So, where do investors go from here? Joining us are Matt Roddy, he's portfolio manager at Rockland Trust, and Ron Weiner is partner at RDM Financial Group at Hightower. Guys, good to have you here. Matt, let's start with trade. We heard the president talking about it. There's a lot of consternation out there. Is that what's driving the markets lower, or are the concerns about trade overblown?
I think they're a little bit overblown. I mean, my mama said there'd be days like these, and there's a lot of noise out there. The trades and the tariffs is really small in comparison to the stimulus from the tax cuts, the potential for repatriation, as well as the spending on infrastructure, which we do think will come to play sometime at the end of this year potentially.
And Ron, how about you? Where do you think trade plays out here? Why is the market lower today? Is it because of trade, or just taking a break?
Well, I agree with Matt. Trade's not that big of an issue, especially us in China, relatively speaking. And the fact that the market's down a little today is really not a concern. You're building wealth, it's got to be over time. So, let the jitters come out in certain sectors. Doesn't matter. You pick your thesis, you go with it. And we see the world as more than half full. So we see the pie expanding globally, more people that are buying cars and toilet paper and iPhones. So we're still bullish on the world and thus the U.S. In fact, we're more bullish on the U.S. than foreign right now.
The toilet paper indicator.
Yeah.
Although I'm not so sure those companies are doing so well.
Right. I mean, the people who make the toilet paper, that is.
Right.
Ron, then if you think that the trade wars are overblown, do you step in and you buy the stocks that have been whipsawed around by trade fears? For instance, I mean, Boeing has been the poster child, and you probably had an opportunity if you are a believer in the longer-term story and think that the trade war fears are, in fact, overblown.
Yeah, well, we're wealth managers where we manage for whole families, and so we build over time. Boeing is a great story where there just isn't enough time for them to build enough planes in their backlog. The shortage of pilots. The world is expanding. We're going to be a lot more like the Jetsons than the Flintstones. So to sell Boeing at a certain time and then get in at a certain time, we think that's fool's play. You pick your good companies, you stick with them through these ups and downs, and that also creates capital gain of a long-term nature versus a short-term. So building wealth is not about trading for us, though we do move the portfolios about 20% a year.
Matt.
But no, we're with Boeing.
Yes.
We're with Boeing.
I just wanted to highlight something that Bob Hassani brought up, some weakness overseas, especially in Europe in terms of the economic data, and that's leaving aside the huge political risk right now in the Euro's third biggest economy of Italy. Can the U.S. market really rally with those sort of headwinds? I mean, it creates a stronger dollar, which we know multinational earnings don't like, and this whole rally over the past few years has been predicated on this synchronized global recovery. If that breaks up, doesn't that hurt U.S. stocks?
Yeah, I mean, certainly the global story is a little bit more lumpy than it was in 2017. Remember, the euro rallied last year. A lot of currencies rallied against the dollar. I think that impacted their earnings negatively, just like it helped ours. So I think as that's sort of beginning to unwind that trade, I think you'll see some benefits back to them, lobbied back over to them versus us. And this whole trade war thing, it's out in the open. It's very loud and vocal, but this has been going on for centuries. It's just a lot of times it's been done more quietly in the backroom, backroom dealings.
Yeah, and it's certainly not quiet now, Matt. Thanks, Ron. Thanks, Matt.